right, so hello and welcome to another CryptoCFOs Watercooler Wednesday. Today we're talking about the IRS 1099-DA draft form. So this is not a final form, but it's really key to start having these discussions because the reporting requirements start as of January 1st, 2023. So that's for the cost basis reporting. So it's important for anyone who's considered to be a broker by the IRS definition to have a good understanding of what they need to be reporting and what needs to be in place in order to get compliant and stay compliant. So we have joining us today, Nick Farrer. He is, remind me of your title at Forbes.
Senior manager, but also blockchain and digital asset practice leader.
There you go. I knew you were the practice leader of blockchain and digital assets, but I didn't know what the full title was. So thanks for that. So he actually just jumped off another call discussing this. So he's going to help us kind of make sense of this all, and we're going to bounce back and forth. And if anyone has any things to add to this discussion, please hop in. So I'll just let Nick give a quick introduction to himself, and then we'll get started.
Yeah, good morning, good afternoon to everyone. Excited to be here with you all today. So, as just mentioned, I'm the blockchain and digital asset practice leader for Forbes. We're the 8th largest CPA firm in the US right now. On June 1st, a month from today, we're going to be the 8th largest firm globally as well because we are acquiring Mazar. So super excited about that. And maybe just a little bit of background. I've been in crypto since 2017. Shamefully, I had a friend tell me about Bitcoin in 2014, and I laughed in his face and didn't listen to him. So I wish I was in sooner, but unfortunately, got in and maybe fortunately got in 2017. So that kind of led to where we are today.
Awesome. Well, it's good to have you. Awesome to have people that are at the forefront of this on discussions as well, so that we can really dissect these complicated issues. And as we'll get into, there's a lot of things that we still don't know or kind of need more information on how to report things. So we'll kind of outline what we know, what we don't know, and what some of the challenges are here. So without further ado, let's just get into the discussion overview. So today we're going to be more focused on the compliance and reporting, like the reporting requirements for businesses, organizations, or brokers, so that we can kind of see what compliance looks like from a business's perspective or an organization's perspective. We will touch a little bit on like what this will look like for investors, but the main focus here is going to be compliance. So we'll get into an introduction of the form DA, including the history and kind of how we got here, which partially is the reasons for this form as well. We'll look at who's affected. We'll look at the reporting requirements, challenges and issues, and then just preparing for compliance. So here we go. So just kind of before we get started, here's some key points that I just wanted to highlight. So the government loses almost 14.5% of revenue due to non-compliance. So this isn't enough money to substantially narrow or even eliminate the federal deficit. Third-party reporting of income is effective at improving reporting of income, but it doesn't increase however, increased reporting of income from third parties does not necessarily lead to increased tax revenue. So finally, increasing the chances of audit is the most effective way at reducing tax evasion. So jumping right in. So the purpose of this form is to it's designed to get more people to report these things, right? And so any digital assets. And previously, we haven't included NFTs or stable coins as part of this, but this specifically outlines that both of these are included. So this form is meant to bring additional clarity and enforcement compliance in the taxation of digital assets. As far as the scope, the form will capture essential transaction details, including the cost basis of digital assets, the proceeds from their sale, and the dates these transactions, among other information. The key thing here is that I think the TradFi comparison that we can look at is the Form 1099-B. A lot of the things that you are required to report on the 1099-B is going to be what is reported on this as well. And the goal here is to make sure that we have third parties reporting what it's supposed to provide an informational avenue for the IRS to see whether or not what you're reporting in your return matches what they're receiving from third parties. And so Like if you didn't check the box on your Form 1040, which asks if you've traded in digital assets or virtual currencies, or received as payment or a number of other things. If you're not checking that box, but they're receiving informational reporting from third parties saying that you have these transactions, the IRS is going to look at you and there's a higher chance that you're going to get audited, right? So it's just a way for them to easily compare whether what you're reporting on your tax return lines up with what third parties are reporting to them. Anything you wanted to add there, Nick?
Yeah, I think you were saying this with the statistics earlier, but really just wanted to highlight the fact that when there is third-party reporting, compliance for taxpayers is above 90%. But when there is not third-party reporting, it's below 40%. So that's really what the IRS is going for here is let's get that third-party reporting so that we can get more people compliant with reporting their crypto transactions. I think, going back probably 5-7 years ago, there was a lot of misinformation floating around that, digital assets were anonymous. You didn't have to report them. There was no way that they could track you down, things like that. And so there were probably a lot of taxpayers that weren't compliant. And I think, that's the main goal here is for the IRS to crack down on that.
And I mean, there's a moral obligation here, but that's not really what motivates people. The vast majority of people aren't motivated by a moral obligation to file their taxes. And I think that it's like, to your point, these people, they're like, okay, there's no way the IRS can track that. And people still think that. I think that that's a highly held thought in a lot of digital asset investors or people that are, degens. A lot of them think, if this is too complicated for me to figure out and file, there's no way the IRS is going to be able to do that. But the fact of the matter is that statute of limitations for, gross underreporting and things like that gets extended. And so let's say, with the advancements in AI and machine learning, they're going to be able to better identify things, whether it's a couple of years down the road, and they'll look back further and further if they see that the noncompliance is severe enough. So really key to understand that a lot of these myths are not founded in truth. So, as we discussed, the impact here is that it's the goal is to increase compliance, but it may, I don't even want to say may, it's going to increase the amount of headaches and challenges that brokers are going to have, because it's a reporting requirement that they didn't have before. So it is going to be a challenge for brokers, especially brokers that don't really realize or fully comprehend that they are a broker in the IRS's eyes. And we'll get into kind of what the definition of broker includes, to understand, those people that are maybe going to be blindsided by this, even though it's been coming down the pipeline for a little while. So let's jump to what the form looks like. So can everyone see this? It's a little bit small, but maybe we can zoom in a little bit more. Maybe I can shrink my screen a little bit so it looks bigger on your screen. But just wanted to give you guys a sense of what this looks like from the filer's side. And so there's a lot of information here. And one of the interesting things on here that jumps out initially is the different types of brokers. Right in here, you can't really see it super well, but we have kiosk operators, digital asset payment providers, hosted wallet providers, and unhosted wallet providers. And then we have a section for other. So it's an extremely broad reporting requirement, right? And so it's really important to understand that, we'll get into this later as well, but there's a potential for a lot of duplicate reporting here, triplicate reporting, because in a lot of these transactions, there may be, 3 or 4 different brokers involved in the transaction. 2+ is going to be very common with, wallet providers. Maybe it's a decentralized exchange transaction. So you have the wallet provider, you have the decentralized exchange, you may have other parties involved. So there may be, 2 to 3 organizations that are sending in the same information for the same transaction. And so there's going to be a challenge in identifying those duplicate transactions and ensuring that you're not double reporting those or triple reporting those. But that's going to be kind of one of the major things that we're going to see here, I think. So I'll resize this so we can see the next slide. Anything you wanted to add here, Nick?
I mean, it's super interesting to see the checkbox for the type of brokers here, especially digital asset payment processor and unhosted wallet provider. So I sit on the AICPA digital asset tax task force as well. And that digital asset payment processor is one that came up a lot when we submitted comments on the proposed regs. And so, like, if you think about this practically, right, if you're in a brick and mortar store and they accept crypto as payment, but they're using a digital asset payment processor to help them do that, you're going to be standing at the counter, right? And then they're going to be saying, okay, if you're paying in crypto, can you give me your social security number, your name, and your address? Like, and that's just not practical, right? Like if you're in an open setting, in a public setting, and you've got people around, and also if somebody like a clerk is asking you for that information, you're gonna be like, why do you need that information?
Yeah,
Like
and no.
yeah, you're gonna be like, no, never mind, I don't want this anymore, or
Yeah.
you're gonna find some other form of payment. And then on the unhosted wallet provider, I mean, this one came up a lot in the comments that got submitted to the IRS from the proposed regs too. I think it's also good context to know that this 1099 DA is written in the sense of if the proposed regs were current law, and they're subject to change. There's a comment period, and there's also the comment period for the proposed regs. So I expect this to change. Maybe not a whole lot, but I do expect it to change at least somewhat. So for that unhosted wallet provider, I mean, Taylor, you talked about it. Like, one, this could create duplicative reporting, but two, it's gonna be a big burden on those unhosted wallet providers to collect this information, and they probably have a business decision to make more than a legal or tax decision here, because a lot of unhosted wallet providers don't want to collect this information from their clients, and a lot of their clients probably don't want them to either.
Mhm.
So not only do they have a business decision to make of, hey, do we start collecting this information? Then you also have to worry about the legal and the compliance as well. So there's a lot of moving pieces going on.
Well, this also flies directly in the face of the ethos of DeFi and blockchain in the sense of like, you know, I think many of us understand that it's not anonymous, but there's also a sense of like the permissionless aspect of it. And so when you start introducing the need to KYC for everything, even for a MetaMask wallet, it becomes, it introduces the chance for discrimination, for example. Like, if you want to use Aave right now, you don't need any permission. They don't need to know your last name or who you are or whatever. And we've seen historically in the US, rates change, prices change for people with certain last names or certain styles of last names. Famously, there's been African American people that have had their houses valued at less just simply because they were present and they invite a friend. And so I'm not saying that exact situation will happen here, but it opens the door for that when you have these reporting requirements and you kind of remove that initial layer of permissionlessness. And I think that part of what's going to happen as a result of this is you'll start to see certain or some wallet providers or some people that are considered brokers start to geo-block US IP addresses so that they can't participate. And I think a lot of what this is going to do is drive innovation offshore, which we're already starting to see.
Yeah.
Any other thoughts there, or?
No, no, let's continue on. I have several other thoughts, but we'll get to them.
Well, yeah, okay, cool. So why was this created? I don't know if you want to take this one, Nick,
Yeah, sure.
yeah, sure.
Um, so it was first brought into law in the 2021 Infrastructure Investment and Jobs Act that was passed in November of 2021. That was one of our current president's first bills that was actually passed into law. The goal was, to invest money into infrastructure in the U.S. One of the revenue raisers to do that, to pass this bill, was implementing a third-party reporting regime for digital asset transactions, and they estimated that it would raise about $10 billion. Now, why $10 billion is, the number that they came up with, I have no idea. Why $10 billion is, super important to come from the digital asset industry and not some other industry, also have no idea, other than we know that the IRS has been trying to track down individuals and taxpayers that have not been compliant in the past. And so they saw this as an area of opportunity to increase compliance. I think it's also a little bit laughable that they estimate this will raise $10 billion in revenue, but they have not estimated their cost associated with this, which I think is going to be probably more than $10 million if I had to guess. So it may actually be a net negative in the grand scheme of things. So yeah, I mean the next bullet point kind of touches on it too. You know, the IRS has been trying to crack down on non-compliance for a while. They have Operation Hidden Treasure that they started back in I think like 2019, which is basically their name for the project of going after people that are non-compliant by using their own software, or also, you know, hiring companies like Chainalysis to track non-compliance. And they've also been successful in getting John Doe summonses from companies like Coinbase and Kraken and others, which has been super helpful for them. So yeah, I think that's a general background, a little bit of a history lesson on how we got here.
Yeah, I think that yeah, it's interesting to see that this all came from the Infrastructure Investment and Jobs Act, and kind of like how, you know, it's just a civics lesson in that, like, things that are completely unrelated to what the bill is about are generally introduced in these large bills that get pushed through. So who is affected? So I think that it's important to understand kind of like we talked about this a little bit based on the checkboxes on that form. Can you I want to understand this better as well, Nick. What's the difference between a hosted and an unhosted wallet provider? I know that an unhosted wallet provider would be like a MetaMask, I'm guessing, but then would that be like maybe like someone who's taking custody of your assets would be a hosted wallet provider?
Exactly. Yeah. So like a Coinbase, right? Not
Okay.
Coinbase wallet, but like the Coinbase app.
Okay, yeah. So where you don't have physical possession of the keys for your digital assets, so they're not really discriminating between whether it's um, a non-custodial or a custodial. They're just using
Right.
different terms there. So I think one really interesting thing for me with all of this is the unhosted wallet providers, you know, like a MetaMask, where effectively it's simply a UI that is making it more easy to transact on the blockchain. So there's not really any service that MetaMask itself is providing other than the UI, right? And so they're making it more easy for you to interact with the blockchain network. They're making it easy for the average person to interact, but they're not taking your assets. They're not directing your assets. They don't have control over your assets. It's just simply that they're helping you to interact with the blockchain in a way that's not just, you know, having to go through smart contracts and needing to understand solidity in the example of the Ethereum network. But so this definition is extremely broad. And it includes persons and people who act as digital asset middlemen. And so, you know, in the example of MetaMask, you know, you connect your MetaMask wallet with different websites like Uniswap, for example. And so in that case, both MetaMask and Uniswap would be a broker in this case. So they would both be required to, yeah, go ahead, Nick, you have something to.
Yeah, actually, if I can jump in. So, if it's just an unhosted wallet provider that does provide that UI to make it easier for you to transact, that's not going to be considered a broker as the proposed regs are currently written.
Okay.
So if you have, I can't think of one off the top of my head, but if you have another unhosted wallet provider that you use and you're just connecting it to like some of these decentralized apps, right? Like that's not a broker.
Okay.
The reason MetaMask is considered a broker as it's currently written is because you can perform transactions within MetaMask itself.
You can
And they
swap,
have,
you can
yeah,
upload funds, and you can, yeah, okay. Yeah, yeah.
exactly, which is fairly recent. Like right when MetaMask was first created, you didn't have that ability to swap from within the wallet. But
Mhm.
now that you do, that makes them a broker because they're affecting trades on your behalf.
Okay, understood. So in the event of you connecting your MetaMask wallet to Uniswap, only Uniswap would have to report that because they're not initiating or directing the funds, or, you know, they're not doing it within their hosted wallet app. It's a separate app that you're then connecting.
Exactly.
Okay. Okay. Good clarity there, because I didn't understand that. So that makes sense. So, you know, not surprisingly, this is not well received by the digital asset community for the reasons that we've outlined so far, which are, you know, this is going to move innovation offshore. The inventor of Uniswap actually said that, you know, it's not advantageous for us to be, you know, headquartered in Brooklyn, but we did this because we think that this is a, an innovative place. We want to keep this tech in the US, and you're basically forcing us to go offshore. And you're seeing a lot of this happening. You saw it, I think it was maybe last year, Coinbase started another headquarters offshore as well. They're pushing innovation offshore with these types of measures because it's becoming overly burdensome. And this is the kind of like the cherry on top for all this. There are notable exclusions from this, and so that would include miners, hardware wallet manufacturers, and software developers that are not directly engaging in transactions. So to Nick's original point about MetaMask, if it's a wallet provider that does not have the functionality within to do swaps or bridging or things like that, they would not be affected by that. So I don't know if it still exists, but there was My Ether wallet back in the day. I don't know if they have that functionality or not, but so key thing to understand. So this will impact centralized exchanges, DeFi platforms, digital wallet providers, and as Nick said, digital wallet providers that facilitate transactions. All right. Any comments or questions from anyone in this call other than Nick or myself? If you do, just hit the raise your hand button and we'll answer those. I just want to make a note here that the IRS has not yet published separate instructions on preparing the form. So we have instructions on folks who have received the form, but we don't have a guide for brokers so that they can help build and implement information systems related to this form yet. So that's a key thing to note. So we're going to get into some of the reporting requirements, but it hasn't been released yet, the instructions for those on the compliance side of this. So right now we're kind of like, we're diving into it, but we still need to hear from the IRS some additional insights on how we can comply, basically. Nick, could you just help us understand a little bit of what some of those reporting requirements are going to be, and kind of how, as I just mentioned, we don't know exactly, but like how at the outset we might start to look at compliance in this realm.
Yeah, would you mind maybe going back to the slide where it shows the 1099 DA?
Yeah.
While you're doing that, I think, one of the things that's been thrown out there in headlines is that this is like a under the cover way for the Treasury and IRS to require KYC for a lot of these companies, right? I'm not sure if that's entirely true. I kind of believe it. The reason that I kind of believe it is because if you look at the watermark here, it says Treasury/IRS, and underneath the Treasury is FinCEN. FinCEN, if you're a money service business, you have to register with the FinCEN and comply with BSA AML, which requires KYC, all that sort of stuff. So it doesn't surprise me that this is kind of like a pseudo KYC type of regime, if you will. I'm not sure if that was their original intent, but basically, if you're a broker, you're going to have to, have that KYC onboarding platform now to collect the, name, social security number, address, things like that of the taxpayer. And can you zoom in a little bit, Taylor?
Let's see. Maybe I can shorten the screen. I don't know if this helps, but
yeah, that helps.
Cool.
And it looks like Lourdes might have a question as well. Do you want to?
Yeah. Here, Lourdes, why don't you ask your question real quick?
Hello. Where does minors fall under? Because I understand as of today, FinCEN doesn't require them to register as a money service business. So what category would they fall under to file taxes?
So they are excluded.
What are your thoughts?
They are excluded from this.
But eventually they're going to be included.
Not according to the regulations as they stand. They're not included
Okay.
in this reporting. So they would file under whatever entity type that they have they've elected. So if they're a C corp, they'd file on the 1120, and they would just report their income and then their general, their ordinary necessary business expenses on that form, and just file like any other normal business. But they don't have any requirements related to this form.
Okay, thanks. Thank you.
Yeah, I think that maybe what Lourdes is referring to is that there's a certain senator from Massachusetts that's been really vocal about her anti-crypto army and wanting to require miners and validators to comply with BSA AML here recently. And I'm very skeptical that would actually get passed, but she's been very vocal about it.
Interesting.
Yeah, so going back to the 1099 DA, so on top of the taxpayer's information, right? It's going to depend on the type of transaction and the type of broker you are based on some of these other boxes that you need to fill out. So let's work through some examples. Let's say that I transact only in Coinbase on the exchange, just buying and selling crypto through there. They're going to have my proceeds, they're going to have all my cost basis, and down towards the bottom right of the form, box 11D, they're going to check that box to say this is a sale that is not recorded on the distributed ledger. Okay, so everything's combined to the exchange, so you know they can provide a lot of that information. Now let's say I buy Ethereum on Bitcoin or Ethereum on Coinbase. I send it to an unhosted wallet. I perform some transactions on Uniswap, and then I send it to Kraken, and I ultimately sell it on Kraken, right? Kraken's not going to know my cost basis because I bought it on Coinbase, sent it off the exchange, performed some other transactions, and then transferred it in. So in that case, Kraken is only going to need to report gross proceeds from your sale when you ultimately sell it in Kraken. And then Kraken will again check that box in the bottom right, check if checking that it's not a sale recorded on the distributed ledger. Now those transactions that happen in between Coinbase and Kraken are that maybe happen on Uniswap. Those would be reported on Uniswap, but Uniswap is also not going to know what the cost basis is because they bought it on Coinbase, right? So they're only going to report gross proceeds, and in this case, they're going to have to fill out more information. So if you look at like box 11A, there's going to be a requirement to report the transaction ID or the hash, if you will, of the transaction. They're also going to have to put the public address in box 11B and then the number of units in 11C. So more information that's going to be reported if it's on-chain versus if it's combined to a exchange.
So this is like doxing more information than you, because when you report your crypto transactions personally as an individual, you never had to reveal your wallet address. You just would report what you bought, sold, any taxable transactions you report there. And so this is going to give the IRS a tremendous amount of additional insight to be able to look into the wallets that you presumably own based on this additional information.
100%. I don't think it's being talked about enough is that the blockchain is public, right? Like all of the information is out there. You can go and query it. That's why, data analytics firms like Chainalysis exist. And if you're doxing every public address and you can attach a name to it, then you can see the balance in their address as well, which, you wouldn't share your balance in your bank account, right? But this is effectively what this is going to do.
Mm-hmm. Another kind of thing on here, I'm not seeing exactly where it is, but there's a box for reporting the TIN, and if you don't have the TIN, it's like gives you're supposed to explain why. Where is it? We can come back to it later, but another interesting piece there is that hasn't been an option prior, right? Because any other 1099 form, you would have that information, or you need to have that information. And so there wouldn't ever be an option to not report that information, right? And so I'll kind of jump ahead to do you have any other thoughts on this page? Anyone have any questions on this slide or the form itself? Or did you have any other examples, Nick?
No, I think the 10 is going to be a challenge as well. And I think that speaks to the complexity for brokers. Generally speaking, if there's a payment that you make and it goes to a foreign person, you're supposed to withhold foreign withholding at typically 30%. So if the broker in this case can't identify you as a US person, not only do they have to comply with the reporting regime to report a 1099 DA, but they're also going to have to figure out a way to withhold your foreign withholding as well. And how do they calculate that when the transaction is being performed in crypto and they need to convert it and pay it in fiat? So it's going to be just honestly a nightmare if you're a broker in that case and your customers are foreign individuals.
I'm really curious as to how this will actually play out, because it's like, you know, the issues that you're bringing up, it's like, if I'm, you know, the Uniswap Foundation, I don't want to have any US persons coming anywhere near my platform anymore because of the insane requirements that this is going to cause. So, you know, I don't know if geo blocking absolves you of that requirement, because, you know, presumably someone could get around that very easily by just using a VPN and then accessing Uniswap. But I mean, it's going to it's going to be extremely interesting to see how this plays out, because I haven't seen any whiffs of this on any decentralized exchange platforms as to anything indicating that they're going to start requiring this information, or there doesn't seem to be any kind of like movement in the DeFi space on this. And I'm just really I'm holding my breath to see what happens, because I think it's going to cause a lot of volatility in the market, first off, and I think it's also going to inform a lot of very interesting debates and issues. I think there's going to be a lot of different interesting ways that these DeFi platforms are going to handle this. And I think, yeah, big thing is just going to be shutting US participants out of it.
Yeah, it's unfortunate. I think honestly, one of the biggest winners of this is Coinbase, because not only do they have Coinbase Exchange, but they have Coinbase Wallet, and they can still offer that unhosted wallet, but share information and be one of the few enterprises that probably can comply.
Yeah. I think we were on reporting requirements. And so we talked about who is it affected, and now we're on reporting requirements. So, you know, we've highlighted a lot of these. The easiest way to think about this form is thinking about it like the 1099B. And Nick and I, when we were preparing for this, Nick brought up a really good point that you know, obviously we don't have clear guidance on how you can comply with this, but I think that there's going to be, or Nick mentioned that he thinks that there's going to be the possibility to maybe summarize transactions by individual. You know, maybe it's by asset type, so that you're not having to do, you know, an exhaustive list, because you will have people who are day trading crypto that are, you know, doing hundreds, if not thousands of transactions a day. Maybe they even have a bot. And I just can't even imagine the insane legwork that these different brokers are going to have for people who do, you know, because there are people who do thousands a day. And so to think about the reporting requirement from that, just from an information perspective, I think you're going to see a lot of summary reporting and things like that.
Yeah, the actual transmittal to the IRS, there will be a separate 1099 DA sent for every transaction to the IRS. So if you're a broker, you're sending millions of these, right? Mm-hmm. Probably, more than likely. So the IRS is going to get probably billions, and they've even alluded to the fact that they're probably going to get billions of these 1099 DAs, because each one is transmitted separately from the broker. But I can't imagine if you're a taxpayer and like you said, Taylor, like you have millions of transactions in a year, there's no way that like it makes sense for you to receive a million of these 1099 DAs.
Right. So it, you know, again, I mean, we've been talking the whole time about challenges and issues, but we're going to get into some more specific ones as well, like, and continue discussing this, because it's just riddled with challenges, right? And it's why we need to stay on top of this stuff. You know, we've been talking about how this, you know, the closest thing that we have to an existing 1099 is the 1099B, but the requirements for reporting go significantly beyond the information that TradFi brokers are required to report on 1099B. And so one of the things we alluded to before was, you know, the explanation if there's no recipient TIN. So this draft form, you know, has a lot of similarities to 1099B, but unlike any form 1099 ever, if the recipient's TIN is not reported, there's a box for explanation if no recipient TIN. And so this is the first form 1099 that includes this type of box. The draft instructions do not refer to this box, so it's kind of unclear how the IRS intends to use it, but the proposed regs would not require the explanation of missing tins on Form 1099 DA. So it's kind of like up in the air as to how this would be handled. So, you know, there's a lot of stuff that the IRS still needs to give us guidance on in order to prepare for this form, right? And so we can kind of get into what we know, but we also have to identify, like, we don't know what we don't know kind of things. So we've discussed the tracking and reporting challenges, you know, and the inherent difficulties therein. You know, there is a potential for inaccurate reporting here, where transfers between wallets might be construed as sales or purchases, when in reality they're just transfers. We've talked about the duplicate reporting concerns. And then we also highlighted the how we could potentially summarize and aggregate, but Nick clarified that the individual transactions will all need to be reported to the IRS. So whether or not the individual themselves receives a summarized Form 1099 DA from each kind of DeFi platform or broker that they use, that remains to be seen. That would make sense. And I think in some cases it will be the only possible way. But for each individual transaction, the IRS reporting is still going to need to be individual for that. So, you know, just the software requirements and the you know, to be able to compile these and effectively get these to the IRS is going to be a challenge in itself.
Yeah, I mean, when you compare the amount of time that traditional finance had to get up to speed on 1099Bs, I mean, they started in the 80s, and granted, we were on, you know, paper and pen at that point, but in the 80s, they had to start reporting gross proceeds. And then towards the late 2000s, I think a law was passed to then require traditional finance to also report gross proceeds and basis. And they had 5 years to get up to speed on that. And I think it's incredibly aggressive to think that crypto, which is even more complex, can get up to speed in a matter of just a couple of years. It's and especially the complexity with which the regs are written. 282 pages of proposed regs is incredible.
Well, and also, you know, the reporting requirement is already started, right? You know, they still have to report cost basis back to January 1st, 2023. So we didn't even have, you know, years to prepare. It was retroactive. You have to have already had this information, right? And so not all of it, but the cost basis piece of it, which, you know, effectively it's effectively requiring you to have all the other information, right?
Mm-hmm.
So not as of right now, but you know, when you go to report those 1099 DAs, you'll have to have had that cost basis in for that individual.
The reason you have to report cost basis back to 2023 is because when it was passed in the Infrastructure Investment and Jobs Act in 2021, they set the effective date as 1/1/23, but then the IRS came out and said, hey, we haven't had enough time to issue regs on this. It's actually not effective until our final regs are published. Well, then they got pushback from congressmen and women saying, well, no, this is supposed to be effective on 1/1/23. So the way that they kind of captured that was, okay, well, you still have to report cost basis back to 1/1/23.
So Sharon, yep, had a question or a comment. There's a page in the 1099 DA package called instructions for recipient, which provides line by line. Okay, so maybe that came out more recently. I hadn't seen that yet. So that's good to know that. Oh no, so we do have instructions for the recipient, but we don't have instructions for the providers of this, for the filers. So yeah. Yeah. What else? I had another note that I wanted to. So, you know, it's unclear as to why the IRS needs the information. But I think a good thing to note here is the backup holding for foreigners or foreign. Sorry, Nick, you were mentioning it before, like the requirement to withhold for some of these transactions for folks that they don't have the TINs for, right? that's a huge challenge I think that they're going to come across. And I think you alluded to it before. And do you have smart contracts automating this withholding that then maybe gets returned to people if they fill out that information, or a smart contract that with each swap, not only do you swap the assets, but you swap out a certain amount of the assets into the a stable coin or something like that. It's the implementation of this for DeFi platforms is going to be insane.
And also from a customer perspective, can you imagine if you performed a transaction and then automatically you had 30% less in your wallet because you performed that transaction?
Yeah.
You're probably thinking, what the heck? Where do my
I just got
assets
scammed.
go?
I just got scammed,
Yeah.
right?
Yeah.
So, yeah, like I said, it's interesting to not see any whiff of this on any of the DeFi platforms. Yeah, like, you don't have any inclination that this is coming down the pipeline from the Uniswap, from like, if you go and log on Uniswap. So it'll be interesting to see the day that switch is flipped, to see the reactions from people, because, we're on top of this as tax professionals and accounting professionals, but the average Joe that like hears about this stuff happening, but is still kind of going business as usual, that then logs onto Uniswap. And then the next day, now all of a sudden they have to upload a passport photo or whatever. I think it'll be an interesting day when this goes live on the DeFi platforms.
Maybe one more comment on the duplicative reporting.
Mm-hmm.
And I think I've seen Sharon post about this. So let's just talk about an example. I'm in MetaMask. I connect my wallet to perform a transaction on like a Uniswap. So actually let me take that back. Let's say I'm on Exodus. I know that Exodus, you can perform a transaction from within their wallet, and they actually use an aggregator like 1inch to help them perform that transaction. So in that case, I have a 1099 DA from Exodus. I probably have a 1099 DA from 1inch, and then I probably have a 1099 DA from whatever eventual, decentralized exchange that 1inch landed on. So I get 3 different 1099 DAs for the same transaction, right? And none of them are going to show me what my cost basis is, because they probably don't know what my cost basis is, because they're all unhosted or decentralized. So I get 3 1099 DAs, all with the same gross proceeds. And I get this, and maybe I'm a taxpayer that I'm not very friendly with taxes and how they work, or I'm using an advisor that doesn't know how crypto tax works. And so we're just going to report all of it on my tax return, and I'm going to wildly overstate my income if I did that. So
Because not only
it
do you
really
not have the
highlights.
cost basis, you don't have the cost basis, so you're not getting the benefit of the reduction in the gain from that. Plus, you're getting triplicate reporting. It's yeah. Sorry I jumped in there. Sorry about that.
No, you're good. I mean, it just highlights the importance of, as advisors working with our clients in the space, we're going to have to go through a reconciliation exercise to start with the 1099 DAs more than likely as the starting point, and reconcile back to what actually happened. And in most cases, when you get 1099s like this, you typically report the gross amount, and then you have like an adjustment on like the line below it, or to some extent to reconcile back to what actually happened. So then the IRS can match, okay, they got 1099s with this total gross amount of gross proceeds, so that they can match that to your actual 1040, but then you need to have like another line item to reconcile back to what happened.
And just for those who are unfamiliar with 1inch, 1inch is, as Nick mentions, it's an aggregator. So what it does is it picks the best path for your assets to go through based on the different DeFi platforms that are existing on that chain that you're transacting on. So if Uniswap has the cheapest path, and maybe it's a cheaper path to go from one liquidity pool to another one, and then execute that transaction, or if it's another DeFi platform that does DEX swaps, it'll give you the opportunity to pick the fastest or the cheapest or whatever. And so that's where you're having multiple of these brokers involved in the same transaction, because 1inch is the aggregator, but then also you have the other DEX platforms that are involved in the transaction as well. And it could even go through multiple different DEXs. It could go through 5 different DEXs if that's the cheapest way to go through, because maybe the liquidity is spread in such a way. So really key to understand that this is just opening up Pandora's box. any comments or questions so far, and then we'll jump into kind of preparing, what we know so far, because we can't prepare completely yet, but how we can start to look at preparing for compliance.
So I think for my weekly rant, pretty much, unfortunately, for the last 3 weeks, it's been the same rant over and over. But it's disheartening to be an American citizen and see what's happening in the space, and I keep using the same analogies, like in almost every massive industry, from auto to pharmaceuticals, even to entertainment, like the largest industries, the US has usually been the leader or very close to being the leader in the space. And I think in this, in the crypto space, sphere, Web3, whatever you choose to label it as, I don't see us being a major player at any point in this game, and it's really not a comforting thing, to be here and to see these massive organizations leaving, that makes it even worse. It makes it feel even worse. And it's just that I see it being an unfortunate shift in power. And I think it's ultimately because those that are making the regulations and putting things into place don't understand how life-changing and massive this industry is. So I think they don't feel the importance to change. As you said in the beginning, it's such a small number to them. They don't look at it as being that important. And I think that's the worst part. And, that's why we do our part on the education side. And I really do I hate complaining about things when I don't have an answer for it. But I mean, everything we've talked about for the last 3-4 weeks based on this topic, it seems impossible. It's like, how is this going to work? And, I'm just a marketing guy, and I think this is horrible marketing for our country. And I think even from this space, I mean, maybe, you professionals on the call understand how this works better than me, but I don't see how there's too many way too many moving parts just for an individual. There's, I know people who are making, hundreds of thousands of transactions a year as an individual, and this is like a side gig for them, so I couldn't imagine somebody that's really in the space and really doing this. And so my question is, do you think in the near future, or maybe now, is there a way that you think the IRS will be able to just take this information like from the blockchain and kind of remove the individual and even the exchanges and everybody else from having to report anything? Or like
the thing here that's key to understand is that you have to go through the people, like at the point of initiating the transaction is where you need to collect that information. And so you can't just pull this information. Doesn't exist on chain, so you have to pull it from off chain, which is like, if you basically, the requirement is making it so that you have to present this information in order to process this transaction. And so the IRS wouldn't be able to gather this information. They're going to rely on the third party wallet providers or dexes or things like that to comply with this. So it's not stuff that exists on chain. So until there's something that exists on chain, which I was having a discussion with Chris Wade from Bitwave a couple days ago about their solution for this, and he was mentioning that there could be a solution here where you maybe have soulbound tokens that are issued to folks that have their identifying information, that maybe you could if that NFT is in your wallet and it has your social security number, but maybe it's not like directly visible, maybe there's some sort of zero knowledge technology where you can't view it just by looking at the wallet address, but someone who is a wallet provider can then glean that information for these reporting requirements to simplify it. That might be a solution. But ultimately the US benefits more than I think the regulators and the people on the ground floor recognize, just based on the prevalence of stable coins, because these stable coins have to have reserves backing their coffers. And those reserves aren't actual US dollars in a vault, it's US debt. And so the digital asset market creates an enormous marketplace for the US to essentially sell their debt. And basically we're subsidizing the US government when you leverage the blockchain in a way, because the prevalence of stable coins on chain are effectively just US debt. And so the US benefits more than any other country from digital assets, just based on their ability to have a market for their debt. And I think that, just anecdotally, I talk to a lot of people just in the position I'm in at CryptoCFOs, and I talk to a lot of people globally. And what I'm hearing is that, in years and in market cycles past, the US was always a major player in discussions, whether you're in Europe or you're in, Southeast Asia or you're in, Australia. The US always had like a seat at the table in the back of people's minds, and people were always paying attention to it. But that role is going away. It's still there, but it's being limited because of all these kind of harsh regulations that the US is rolling out. Because people want to maintain the ethos of pseudo anonymity and of just the ability to protect your own privacy on chain. And these regulations like this are eliminating that possibility. So it's I think these are key items to understand. And so just the final kind of slide here that we have for you. I'd love, Nick, I don't know if you want to jump in on this and just talk about some of the kind of steps that brokers and taxpayers can take to kind of at least begin the process of preparing for compliance on these.
Yeah, if you think that you're a broker, or there's some doubt in your mind if maybe you are a broker, I would definitely suggest reaching out to an attorney, getting some advice from an attorney on how to approach this, and think about implementing a KYC program now if you think that you're going to be subject to this in the future. Obviously, like I mentioned earlier, that's going to be a business decision in some cases, right? Like if you're a MetaMask and you implement this KYC program, are you just going to lose all of your customers? That's a question that you have to make at the business level, right? Or do you just geo-block the US and go from there? And then, there's going to be a ton of data points that you're going to have to report on this 1099 DA. I mean, that one page there were so many data points there. So, think about collecting this, how you're going to collect all these data points. And as mentioned earlier, cost basis is going to have to go back to 1/1 of 23. So keep that in mind too. And then for taxpayers, one of the things in the proposed regs that maybe got looked over a little bit was the cost basis and how you calculate your cost basis. But basically they said you can use specific ID. There's going to be an administrative burden to do that, because you have to notify the broker at the time of a sale or before the sale that you want to use specific ID. And we don't know exactly how you do that. Like if I'm going to perform a sale on Coinbase, how do I notify Coinbase that I want to specifically identify the cost basis for that? How do I know that they're going to keep track of that? All those sorts of things. We don't know. We need some more advice, some more guidance from the IRS on how that's actually going to work. So in the absence of specific ID, you default to FIFO, right? So if you've been using something like a LIFO or a HIFO, then maybe consider switching to FIFO in your tax year 2024 or 2023 if you haven't filed yet. Another thing is you also have to keep track of your assets on a wallet by wallet basis instead of in aggregate. So you can't take cost basis from, and as an example, Ethereum and Kraken. If you're selling your Ethereum in Coinbase, right? Like you have to keep them separate and keep track of your cost basis on a wallet by wallet consideration. So if you've been doing an aggregate, consider switching to wallet by wallet as well.
So then how would that look like in the Kraken example? Would it be like, so if you, okay, so you're saying the assets that exist on Kraken can't be used for the cost basis on Coinbase, but if you transferred it from Kraken to Coinbase, you could still use that same cost basis because the cost basis would follow those assets.
Yeah, so some crypto software is basically what they would do is you connect all your wallets, you connect all your exchanges through an API, and it just aggregates all of your assets. And if you sold Ethereum in Coinbase, but you still held Ethereum on Kraken, it didn't really look to see on a separate basis if it actually matched up like that. It just looked at everything on aggregate.
Interesting. We do have one question from Sharon, and I don't know if we're going to be able to answer it exactly, but it's a good question to kind of pose. Is how are tax preparers going to report thousands or tens of thousands of 1099 DAs for a crypto tax client, especially when many or most of those 1099 DAs are duplicates of the same transactions from different brokers, or having incorrect or missing cost basis? This seems to be a nightmare coming our way, especially for tax professionals who are not familiar with crypto or have never handled crypto tax reporting. I think this is going to be a huge wake up call for a lot of people. And I think that I think some of the ways, if there's a way to get these in, some sort of software, even if it's in Excel and you could remove duplicate transaction hashes, if transaction hashes exist, I think that's one way to eliminate the duplicates here. Key thing to note there is that you will have duplicate transaction IDs for the, on a swap, you have, if you're swapping, let's say ETH for USDC, you're going to have a transaction hash that relates to the USDC being sold and the ETH being bought. So you don't want to remove all duplicates. So maybe that process doesn't work. So yeah, it's a challenge, but I'll let Nick, weigh in on some of, the ways that maybe we can comply or maybe we just don't know.
Yeah, it's going to be a huge reconciliation process. And unfortunately, our clients are going to wonder why our fees are going up, which may also drive them away from crypto as well. Because if you're going to transact in crypto on chain, you're going to do thousands of transactions, you're going to get thousands of 1099 DAs. Does that make it worth it, right? It's honestly really unfortunate that it's come down to this.
Yeah. And then we have another question from Ryan S. He's saying, if we were not reporting cost basis by wallet, we basically have to go back and reconfigure every transaction to get the wallet cost basis. Is that correct?
If the proposed regulations are the same as the final regulations, yes, unfortunately. I will say that there are some crypto tax softwares that have already built in place where you can basically do this automatically by clicking a few buttons. Coin Tracker is one of them. I'm not sure about any of the others, but I know Coin Tracker already offers this.
Cool. Well, lots of things to consider here. I'll just leave it open for another moment just to see if anyone else has any final questions. But really, really thank you, Nick, for coming on for this. It's been amazing to have your expertise and your guidance on this. And, we will do more of these as we get more information. Maybe we'll do an update. And if you do want to have if there's enough desire for people to do a comment letter or some sort of discussion letter to the IRS on this, we would create a group in the CryptoCFOs community as well to kind of hash these things out.
I did have one question. So what happens? I'm an investor, I'm a trader, and let's just say I have nothing. I have nothing to report to the IRS. I have no paperwork. I have no DAs. No type of paperwork from any broker. Maybe the exchanges and brokers I was operating on don't even exist anymore. What happens to those people? Like, how does that get resolved? And then what would repercussions be? Or like, how does that work?
Yeah, I think this was a misconception before, these regs came out, is that the 1099, receiving a 1099 is what triggers the reporting requirement. That's not the case. It's your transactions that trigger the reporting requirement, right? So the onus is on you as the taxpayer to still report it. IRS doesn't care effectively if you're not getting a 1099. They want you to still report it. So like I think what you're alluding to is like if you had assets in FTX, right? And you can no longer log into FTX. Well, first of all, there's some tax code and there's some question in, did you even have constructive receipt of those sales anyway? So you may not need to even report them to begin with. So I would encourage you to look into that constructive receipt rule. If you still feel like you have a reporting requirement, then you kind of have to do, a back of the napkin best guess, and still try to act in good faith and put something on the tax return.
And then on the flip side of that, moving forward, if I want to ensure that I'm compliant and I'm taking these trades, what should I be doing as far as record keeping? Like what would best practices be from that side?
Yeah, connect your wallets and exchanges to like a crypto tax software that you trust in and think is good, I think is a good start. Or if you want to do it manually, then by all means do it manually in an Excel document or something like that. But yeah, keeping good records is important.
I would say also develop a proactive relationship with your crypto tax specialist. I think that it's a new realm, and the reporting requirements are so high, and the amount of data that's there is so high. So you need to be, if you're a tax practitioner, You need to be periodically checking in with your clients. This is made easier if your clients are in a tax software, as Nick was alluding to, because you will have those wallet balances and you can see the transactions coming in. And so you can ask questions as they come through. But developing a proactive, like for tax practitioners that are working in crypto, this is going to be a year-round activity and not just a year-end activity. Because if you're just relying on getting this stuff done at the end of the year, you're gonna fail to some degree, because there's just too much to handle. And so this opens up the door to subscription models. So spreading that fee out throughout the year, just so that you can stay in touch with folks and you can monitor those wallets and get paid for it. So I think that it's going to change the landscape of how people charge their services as well, because there's a need for you to kind of stay on top of this stuff throughout the year in order to get it right at the end of the year.